All right, we got about a little over a minute. We'll wait for a few more people to get in. If you guys are here already, check in the chat. Let me know you're here, and we will jump into our weekly trade ideas as we like to do every single week. All right, that is the alarm, and we are gonna get started. Give me 1 second to X this out. All right, not the biggest live audience in the world right now. This is maybe our smallest yet, so we're trending in the wrong direction here, but hopefully that's just because people are enjoying their weekend and their Sunday nights. But for those of you that are on with us, we appreciate it, but everyone always does have the option to watch the recorded video on our YouTube channel afterwards. So if you're watching in the future from when I'm talking right now, thank you for that as well. But it's only those who are watching along live with us that can influence what we're going through so far. So the first thing we like to do when we kick off these streams is review what we did last week, talk about our strategy, things that we want to change, things that we want to update. And last week was a very, very good example of a week where we're probably going to change a little bit of our strategy, and that would have to do with hedging. So typically what we like to do is sell SPX call spreads to hedge. And that means that if, SPX, which is the S&P 500, goes down, we make money on these. So the overall thought is that, hey, if our positions right here are dropping, that means the overall market is dropping. So if we lose money on these, that's okay. We'll make it back from the spreads. The issue, as we can see right here with our profit from the HT wheel and our profit from spreads right here, is that our plays weren't necessarily correlated with the market. And it's a great point that we talked about a little bit in our Discord server. But the general issue is that, these stocks that we're looking at right here, for the most part, are not included in the S&P 500. So what happens is if these stocks drop, the S&P 500 can be relatively untouched. So we ran into the problem where we would have red days with these positions on days when the market was green, so we'd be losing on the spreads as well. So that is one area we want to try to refocus our hedging. So the question now is, what do we want to do as part of that refocusing effort? And there are really two avenues that we could take in doing so. And the first is going to be, instead of SPX, use something that includes these stocks to hedge, something with a little bit more correlation. And for our purposes, a lot of these are included in the Russell 2000 index. So instead of SPX, the ticker IWM would be a good ticker to use to hedge. So let me type that in right here, IWM. And this code here. Yeah, so this is the Russell 2000 ETF, and a lot of the stocks that we have and are holding in our account are part of this. Shout out to, hold on 1 second, it's off my screen. I didn't even catch it. Whoever you are that just followed me, really appreciate it. I wish I could give you the shout out by name, but we'll keep it moving because I did not have my streaming window up when I heard the noise. But the Russell 2000 is much more correlated with some of the stocks that we own, and you could view which ones of your, you could view which of your stocks are in which different indices. One super useful tool that we like to look at here in Thinkorswim is going to the Market Watch tab here, clicking on Visualize up top. and then clicking on indices right here, and that'll give you a drop down of all the different indices. You can see Russell 2000, where there are a lot of more mid-cap type stocks, and that's a lot of what we like to play because a lot of those have really good opportunities for premium, and that's exactly what we like to see as option sellers. However, since we were using SPX to hedge, we essentially were hedging based off of these stocks, and outside of, I think AMD might be in the S&P 500. I'm not even sure, to be honest with you, but that would really be, yeah, it's right here, AMD. So that's the only stock that we were playing this past week that was in the S&P 500. So really what we're hedging isn't necessarily correlated with our portfolio right now, and that's something we're going to want to turn around. So, option one in turning that around is going to be to hedge with IWM, since that's the Russell 2000 and it's a little, more closely correlated with some of the stocks that we're holding. And then option two is just going to be to add more of these stocks. We could continue to hedge with XPX because I think it's a great instrument to use to hedge. It's tax advantage. The contract sizes are larger, so you don't have to trade as many contracts, and that saves you a little bit on commission. So there are a few advantages to trading SPX, and that's why I want to continue to trade SPX as a hedge. But just to make sure that our portfolio is more closely correlated with SPX, we're going to look to enter some positions in stocks that are actually included in the S&P 500 so that our hedge works as designed. But let's jump back, recapping a little bit more about what happened last week. Our UWMC position, that one just keeps slowly declining, but it's another one of those things where we're confident it's a solid company. Stocks can't go down forever. If we look at our breakout tab right here, we started playing this at $10.84, and our break-even price is currently, let me zoom in a little bit right here. It is now $6.45. I need to update this right here to reflect that May 21st is now the new expiry day on this trade right here, but our break-even price is down to $6.45. That can be illustrated by us typing 645 into the price and letting the spreadsheet do the rest of the work to get us down to roughly break-even price on that trade. So, that's just speaks more to the power of the strategy that we're doing. The stock has dropped, or could get to the point where if it does go down to 645 by May 21st, we'd be at the point where the stock has dropped 40%, which is just a ridiculous drop relatively for a stock, and we would still be at a point where we're break even overall on the trade. So that just is a good point to emphasize the power of the strategy that we're running right here. But where it is right now, it's at 749. If it stays at 749 by May 21st, that'll give us a 9.6% return on capital, which isn't the biggest number since we've had it open for a few months. It's 22.82% annualized. But that still beats the market average of 9 to 10% for the S&P 500, and that's all we're trying to do with the strategies that we're running. Beat the market on a year-to-year basis. And clicking over to our year-to-date summary, we could see that we had a pretty big speed bump this past week when we went down in the face of the S&P 500 continuing to rip upwards, but we do still have a pretty nice lead as far as profits are concerned on the year. So it's always good when you can learn those expensive lessons and still be outperforming the market. And we can go back to actually show you the dollar effect of what happened with those spreads last week. But on Friday individually, and this is the second point where we made a little bit of a mistake, is the fact that we did 416 expiries. We have a really good feeling the market's going to pull back. And as you could see for the next week down here, a little bit of a spoiler alert. We're still in a lot more call spreads to play that further down as we head into next week. But the biggest issue that we had, and one of the advantages that this strategy provides us with, is the fact that, hey, look, we got a comment from Jules saying it's very blurry on her side. Let me try to update that a little bit. I had to mess with the bit rate that I was broadcasting at, so that might be an issue. Let me hop into the settings really quickly again and try to update that. Appreciate the feedback, Jules. And if anyone else is having problems at any time during this, as some of you who are following us know, my main laptop is en route to the manufacturer right now because it completely died on me. So I've got a backup laptop that is not quite as good from a hardware perspective. So we're having some technical issues on some of the streams here. But I just bumped the bitrate back up a little bit. So hopefully give me a little feedback if that makes the stream any clearer for you. But we're going to keep moving on here. talking about the mistakes that we made with these SPX spreads. So, I mean, it's better now. Awesome. Thank you for the feedback. Sean on YouTube could see it just fine. Appreciate you guys who are all giving me feedback because, as I mentioned so many times, it's just me in the corner of my bedroom seemingly talking to myself sometimes. But I will use that to segue into talking about the chat. We do, at the end of this, are always happy to analyze stocks that you guys want to see. So if at any point during this you have a stock that you want to see us take a look at, feel free to throw it in the chat. We'll take a note of it and circle back to it towards the end of it once we get through, our weekly recap and then our trade ideas as we head into the week. But closing the loop on this point that I was trying to make about SPX, the biggest issue here, and to be completely transparent, on Friday we lost $8,500 on SPX call spreads because the market just kept ripping upwards. We were in complete disbelief, and we could pull up the chart for SPX. Hopefully this doesn't just ruin my computer because the numbers can get so big. Let's see here. Yeah, I mean, if you look at 180-day chart trend that's on, don't see any pullback at all in the past. What do we got? Ever since March 25th, I mean, there's barely a red candle in here. There was one red candle here, and that was last week, I think Tuesday, Wednesday-ish. But that was quickly erased by an even bigger green candle the following day. So, I mean, even in a bullish cycle, you'll see the SPX, the SP 500 index move upwards relatively rapidly, but to see it move up this quickly with no sort of relief or pullback was quite honestly shocking. So we were heavily betting against that. We were incorrect. And as you can see, the RSI, one of our favorite indicators that we like to look at, has SPX in some severely oversold territory. The last time it was this high for a sustained period of time was back in September of last year, when it dropped about 10% over the next month. Last September, it was a pretty bad month in the market, although I think during the back end of it, it rose up a little bit. And I mean, the way the market's been lately, we know, spoiler alert, that even though it was down 10% in September, it was quickly bought back up to get to where we are today. But a point being, there's low volume in the market, which is typically when you see low volume and increase in price, that could be a signal that we're getting towards a peak. The RSI indicates that SPX is severely overbought. We could take a look at charts to see similar setups. And honestly, the back end of this run through August of last year, if you guys are following along and looking, this does look super similar to what we're seeing here as we get into the back end of April. So the biggest issue, and I'm still, pretty confident we're going to see some sort of pullback, maybe to the 4,000 level. But the biggest issue that we had with the play that we made, as you can see here, is the fact that we gave ourselves too little of time frame to see that play actually run its course. We gave ourselves an April 16th deadline, and on that individual day, the S&P 500 went up a bunch, so we got cleaned out on these, and that obviously sucks, but at the same time, I think it's super important to be transparent about when trades go wrong, because there's plenty of stuff that we mess up as well as we do here. We've had a great year so far, even with this included, but anyone on social media, anyone who's making YouTube videos and sharing their trading journey, I guess you could say, I've seen far too many people who act like it's all just, sunshine and roses the entire time. So we think it's super important for when we do have little bumps in the road and make big mistakes like this one, to share that with you guys. So hopefully our expensive lesson doesn't have to be an expensive lesson for you. So moral of the story here, don't give yourself one day to let a play shake out. So what we did for next week is we have 423 expiry for next Friday at the 4,200 level. So if we zoom in here, let's bring it down to the 5-day chart. So as long as SPX finishes below the 4,200 level by next Friday, our spreads for this upcoming week will be just fine. And I think with the amount of profit we'll make on those, the whole spread disaster will be a wash. But we will be sitting on a pretty sizable loss if it does continue to rip upwards. But we do think that the 4,200 and waiting until next Friday, that period of time, is sufficient to wait for a little bit of a pullback in the market. And if we get to Wednesday or Thursday and we haven't seen that kind of pullback, we might reconsider. We might roll those spreads up to higher strikes. That's just something we'll play by ear as we move forward. But that kind of, I guess, rounds out what we did last week. We can go back on the individual names. AMD, small loss, but we rolled that one over to next week. UXIN was a great play for us. That was a super fun one where, very, very low risk. We were able to sell a call with a lot of extrinsic value that was deep in the money. Appreciate that comment, Jules, that it's better in YouTube. I'll probably have to look into that, and then hopefully my old laptop gets back to me fixed, and then we won't have to worry about any of this in the near future. But moving on, talking a little bit more about this UXIN play. Let me zoom in a little bit closer for you guys. Yeah, so we were in a situation where basically we were able to sell. So these were trading for $1.35 the shares, and we saw that these aren't 2.5 strike calls. This is a typo. 1, 2, 3. That's what happens when you copy and paste sheets to set up new trade tracking. But these were 1 strike calls, and they were selling for 42 cents. And since we know that they were in the money by 35 cents, that gap between the 35 cents and the 42 cents, that 7 cents of extrinsic value is something that would decay and something that we would collect over time. And not even, I say over time, it was only a 2-week trade essentially because we set it up on April 1st and were able to have those shares called away from us on April the 16th. So the great part about that is we know if there's 7 cents of extrinsic value on a 1 strike call, that's the equivalent of buying these shares for 93 cents a piece and then turning around and selling them for $1, which is a 7.527% return on capital. And that was on a stock where as long, and we have it right here, we started playing this at $1.35. As long as it stayed above $1, so it didn't drop, 30% on us, we were going to collect 7% in 2 weeks, which, as we can see right there, is 481.85% annualized, which is a really, really solid number. And I'm really like the way that this place set up so much that I'm probably going to try my best to keep an eye on similar setups where there's a cheap stock that has a really quick run up, and we could, take advantage of a similar situation by selling deep in the money calls with extrinsic value and give ourselves a high percentage setup to get a nice return like this one. So zooming back out a little bit and going back over to the trades that we had last week. Let's click on over here. Clover Health, that one was a good one. We sold 7.5 strike puts. That thing exploded up near 9 by the end of last Friday, but we were able to roll these in our position on here. This is a fun one too because despite the fact that we started this at $12.65, our break-even price is now $7.50, and while we won't make a ton, it'll be a $10 profit if it stays above $7.50. I'm perfectly happy to get out of a trade where the stock dropped 30% on us and we didn't lose a single cent. And that again is highlighting the value of this option selling strategy that we use, because even when you're wrong, you get this incredible cushion if you're finding good premium opportunities. It's trading with the cushion makes things so much easier. And while we've had a pretty bad stretch of luck and why our stock picking needs a little more attention, as you can see here, these are the stock returns on the ones that we've picked. And that's in column N right here. But meanwhile, in column F, these are the profits that we've gotten on those. So as you can see, if we just purchased a lot of these stocks straight up, we'd have some pretty sizable losses. And in fact, the average return on the stocks that we've picked so far for the strategy has been negative 2.42%, but our average return has been 6.48%. So that, just further hammers home the point of how useful it is to have that cushion when you trade, because you could pick some absolute stinkers, which we completely have done lately, and still come out with a decent bit of profit over that similar stretch. But again, we'll try to shift our focus a little bit more to the S&P 500 instead of playing some borderline questionable names in the name of chasing premiums. So hopefully that will help us moving forward here. But just we've had a tough stretch of luck, but we still haven't had anything too bad happen to us. As you can see with our yearly account chart, we've kind of just been treading water here for a little bit. So it would be nice if we could finally get some winners, because a lot of these have turned into week after week after week plays, and break through the all-time high that we've had in our account and keep moving forward towards the end of the year. But again, we're up 21.57% this year, despite how bad things have been over the past couple months for us. That's still a great number to be at, and we're going to hopefully keep moving forward from here with our, tweak the strategy a little bit, keep moving forward, and improve on what we see on a week-to-week basis. And that's kind of the end of what we would probably want to talk about for what happened to us this past week. STON maybe is an interesting one we could talk about really quickly. Let me pull the chart up just to take you guys through the timeline of what we were looking at on that trade. Oops, accidentally put a backslash in there, so let me get that out. We're going to put the chart up now. Yeah, and as you can see on Friday, it went up 31%, which was awesome because that was the day of expiry of the calls that we initially sold. So if we back up to the 20-day chart, I think we should be able to see the timeline of our trade. Awesome. So what happened was it was trading around $2. I think some sort of news related to the company came out. It spiked up to $5 a share, and then we got in around, I want to say 2. I can give you the exact number right here if we look at the trade breakout tab that we have. Give me 1 second. So we got in at 270. So what I liked about what we did, we didn't chase something at the top here. We waited for it to pull back and settle down at this, roughly 270 level. And I think we might have gotten in on this day, actually, waited for this red candle. But we got in there. There was some great premium on it. So we were able to buy the shares for 270, sell 2.5 strike calls for 60 cents, which, as those of you who follow us closely know, that means our break-even price on the shares is 270 minus 0.6, so $2.10. So we were happy to get on a stock right here, where as long as it stayed above here, we would make money on it. However, as you can see, it dropped down to 164. I don't think that was actually a price to trade it at, but down near 170 at one point. So we were looking at a decent loss, but patience pays off, and that's the advantage that this strategy gives us. The fact that, hey, we sell these things that expire April 16th. The stock that we're holding never expires, so just hang on, wait till April 16th, and then evaluate what to do from there. And that's exactly what we did. We had another awesome run-up last Friday on April 16th, which allowed us to sell some more calls, 2.5 strike for 16 cents a pop. And we might have jumped the gun a little bit on those because those are going for, I think, even more money right now. Let me open the trade tab to see exactly what they're going for. Yeah, they're going for almost twice as much. They're going for about 30 cents a pop. So that definitely would have been nice, but we were so excited just to see any premium at all on those. So we jumped on the opportunity to take our break-even price down to $1.94. And again, if these are called away from us, it goes back above 2.5. The profit we're going to see on this trade is 26.6% in just under 2 months, and that annualizes to 329%, which is a super, super solid number. So we're perfectly happy to stay on with that trade. And honestly, I think someone in our Discord today asked if they should get in on this. When I said probably not, I didn't realize that the call premium had gotten up to 30 cents. So if you're able to, pull these shares for $2.10 and then sell one for 30 cents a pop, that would get you down to $1.80 break-even price, which is an even better point than we're at, and you would have similar upside over a shorter time frame. So really not a bad setup still on this trade. And even if it levels out, the call premiums here will probably die pretty quickly, and you could just close the trade out, hopefully, for a profit. But one of those things where, hey, if you're looking for a low cost entry on a trade, this really isn't a bad idea, getting yourself down to about $1.80 break-even price, which, going back to the chart, is right around here. And if the stock stays above that, you'll make money. And if the stock goes just above this line right here at 250, you'll hit max profit, which will be a really, really solid return. I think somewhere in the neighborhood of 30% off the top of my head for 1 month. So yeah, not a bad trade. And I am contradicting a little bit what I said in the Discord server earlier. So apologies to whoever's question I asked with that one. Now that I have taken a look at the options chain and know a little bit more about it, I definitely don't hate entry on this one at all. But that finally should take us to the back end of our recap for last week. But let's move into this next week, what we want to be entering, what we want to still hold, what we chose to still hold, and how we're set up as we head into the week of April 18th, which is today. So we've still got this UWMC position. You'll notice we used to have 7.5 strike puts in addition to this series of puts, but we wanted to free up a little bit of capital because we are of the opinion that the market's going to have a pretty sharp pullback soon at some point. So we want to have a decent amount of cash on the sidelines to take advantage of that when it does happen. So we're staying steady with this one. We sold 9 strike calls. The idea here is that if these shares are called away for $9, we might limit our upside to say, okay, if the shares are up to 10 or something, we miss out on 70 cents of profit. But the fact that if it does run up to 9 and we get our shares called away, that consequently means that these 9 strike puts we sold will also expire worthless for what would be a $3,500 gain. So we'd be perfectly happy with that scenario. It's the idea of I think what it's called a covered straddle, where you sell the call and the put at the same strike. And that's different than what the covered strangle is, which we normally do. And that's when you sell the call above and sell the put below. The straddle is at the same price, and it's not a bad play to get in on when you have a stock that's dropped so severely on you and you're looking for a way out. So we're really happy with what we set up right here. We're going to keep rolling on with that one. PSTH, one of those that, any day they could come out with the deal announcement and the stock could fly up. So what we do is we just keep chipping away at our cost basis week after week after week. We're able to get about 25 cents a week on that. So really not too bad at all. This is another one that we started playing at an embarrassing price. Yeah, $31.49 is when we started playing this stock. It's down to 24.2, which is a 23.15% decrease overall on the stock. But our break-even price is 25.76. So if it ever gets back up there, that is the point at which we break even. So we'll continue to sell calls week after week above that basis until those eventually go away. LOTZ, May 21st, 7.5 strike puts. Those are ones that we continued from our May series that we were that we continued from our April series that we were previously selling. I could pop over to the trade breakout tab again. This is what we currently have open right here. Let me highlight that because I have not updated the color coding on this tab in a little bit. And for those of you who are new following along with us, yellow on a position means that it's currently open. So what we did, we started with 10 strike puts. We lost money on those. We rolled those over to April 10 strike puts, lost money on those. And it dropped so far that we got to the point where we said, okay, we're going to keep it with April, but drop it down to 7.5 strike just to get as much premium as we can. That turned out to be a good decision. We made more than we would have if we kept this original one. But from there moving forward, we're just going to keep rolling at 7.5 strike until those are called away, hopefully for a profit. Not called away, but expire worthless. And if these did expire worthless, we'd be sitting on that individual leg a profit of $2,600 and a profit overall of only $70 on the trade, which you might say, okay, $70 of profit on a trade is kind of garbage for the amount of capital we have deployed. And you would be correct, but it is worth taking into consideration that it has also dropped. The stock, that is, has dropped 30% on us. So 70% profit on a stock that's gone down. That is the silver lining on a trade like that. Shout out to T Sports. Thank you for the follow. Always love getting that. Notification. Appreciate you checking into the Twitch chat. If you have any questions about anything we're doing, because I know a lot of people just stumble into what we're doing from typical investing circles and don't fully understand the concept of option selling. So any of these, any of the terminology or strategies we talk about, if anyone wants those explained a little bit more in depth, I'd be happy to take a little segue into that conversation as well. But that's the fun of these live streams. We love having people on, even though viewership's a little bit on the lower side tonight. Hopefully once we do a better job. It was kind of last second plan, so maybe a little bit on me, but once we get more and more people in the chat, if the fun part about these live streams is you guys can really dictate the direction that we go in for once I run out of stuff to talk about with my little spiel. But going back into the tab again to look at what I'm set up with for this week. Again, this is something I'm perfectly happy with individually. We know in the context of the trade that I made on LOTZ, if this expires worthless, I'll have only made $70 overall on LOTZ for this part of the trade. But, between now and May 21st, if this thing finishes above 7.5, that's $2,600 of profit. So, you almost got to think of it like you're a farmer, I think is a great analogy. You're just planting all these seeds. Once May 21st rolls around, all that extrinsic value is going to be gone. If the stock moves in the direction that you wanted it to, you're going to make a really nice profit. And if it moved against you, you just keep rolling as you've seen that we do and move on week after week after week after week. STON, that's the one we just talked about. We're loaded back up with 2.5 strike calls for May 21st. RMO, we haven't talked about that one too much on here yet, but that is one that is also quickly moved against us and is another stock on the long list of stocks that we've done a terrible job picking, admittedly. But again, transparency is important on here to us. We're not going to win every trade that we make, but we do believe that we could save a lot of the trades that we make. And where on earth is my RMO trade breakout tab? There it is. So here is where we are on this one. Let me zoom in a couple times because I added a basis breakout on here to help illustrate what's going on. We started this one on April 7th, so 11 days ago, and that's back when it was at $11.34. It has since dropped 26% on us, but we're in a position now where our break-even price is $8.36. How did we do that? Let's talk about it. We first started with 1,000 shares of RMO, and that was a small position, like we talk about with our HT wheel strategy that we run. We always want to start with smaller positions, and then if shit hits the fan, so to speak, that's when we want to scale in, use the additional capital that we're comfortable investing, and just drive that break-even price down as far as we can, week after week and month after month. And eventually, we can drive that break-even price down as much as we want. The stock isn't going to go down forever, and hopefully the idea is we come out with a profit or break-even if things really get bad. But that's what we did. We started with a smaller position, 1,000 RMO shares. We sold 12.5 strike covered calls because we thought, hey, 11.34 minus 0.66 gives us a break-even price of about 1070 something. And let me finish this up real quick, and then I'll address that question from UT Sports in the Twitch chat. But what happened right there is we wanted to deploy more capital. So on top of these covered calls, we sold 20 cash secured puts, and we rolled those. Now this says we have a profit here, but for the purpose of calculating, we rolled these for a 10-cent credit, so we put those down here. So what really happened in the trade is we bought these back for $1.20, so we actually lost 860. But the net effect is what would happen if you netted lines 3 and 5 right here. So that might be a little bit convoluted. Sometimes I put stuff in here that makes sense to me, but not sense to you guys. So hopefully you guys are following along with what I say when I rolled that for a credit right here. But then these expired worthless. We know that because RMO finished below 12.5 last Friday. So we banked $660 for free right there. And then we rolled those into May 21st, 10 strike calls. We rolled it down just so we can get a little bit more premium. And even if RMO never goes back above 10, we're still going to get $810. So off the bat, we know that we've gotten, just from the calls that we've sold in the time period between April 7th and May 21st, just a little over a month, we're getting $1,500 essentially for free just by selling these calls. And now we go back to the position that we increased our position size with by selling more cash secured puts. Again, these were rolled for a 10-cent credit, and then we opened even more for $1.15. All in all, the net effect of that, we broke it out over here, and this is something I think I want to start incorporating in my spreadsheets. We have a break-even price tracker. So on April 7th, when we started the trade, our break-even price was $10.68. May 9th, when we added those cash secured puts, that dropped it to $9.72. April 16th, last Friday, when we rolled our calls forward to that 10 strike for May 21st, that lowered it even further to $8.82. And then when we sold an additional set of puts, that further lowered our break-even price to $8.36. So the question here is really, we know what we could break even at on this kind of thing, but maybe a better question is, hey, what's the upside here? We like to talk so much about the downside because the basis of the strategy is protecting us against things like this that happen. So what's the upside here? We can get our shares called away for $10 a piece. So if we put 10 in here, it's going to calculate everything automatically. These will get called away for $10 a share, which is a $13.40 loss. But again, we're okay with that because we've collected more than $13.40 just from the calls that we've sold. And then we know that if it finishes at 10, those 9-strike puts that we sold are going to expire worthless. And all in all, we're going to hit a $4,100 profit, which is a 17.37% return on capital. And in the time frame that we've had this going, and I think I might need to actually update this time frame. Yeah, this needs to be updated to 5/21. So in the time frame that we've had this going, a little bit over a month, if RMO finishes at 10, we'll say, and since that's our max profit level, we could be in a position where RMO would have dropped 11.82%, and we have a bullish position on it. We want it to go up, but it dropped 11.82%, yet we still returned 17.38% in just over a month, and that annualizes to just under 300% on a yearly basis. And again, that's why we love finding this kind of premium, because it puts us in these positions where even if we're losing, we're still in a position where we could really be winning. And let me get back to my Google Finance function so I could automatically have the actual price of RMO in there, which is $8.37. And the way we calculate this is this currently shows us what our profit and loss on the trade would look like if it finished at the current price today. So if it finished at $8.37, we'd be in a position where it dropped over 26% on us, which objectively in a month on a stock is an enormous drop, but we still would have made 20 bucks. And that's why we love our strategy. So we did get a question in the Twitch chat. Break this down for option is 100 shares that you have are right but not required to obtain. So I guess the way I'll answer this is there are two different ways that you could sell options. And I'll just do this. I don't want to pull up Notepad. I'm worried if I open another app on my computer, it's going to set on fire. But the first is cash secured puts. And let me make sure I've got okay. And the second is going to be covered calls. And this is a good one to look at for that example because we're actually using both of those here. So cash secured puts is when you sell a put. And if we back up a little bit and know what we know about options, what is a put? It's the option to sell someone else. So if you hold the contract, it's the option to sell someone else stock at a certain price. So if we sell that put to someone, it gives them the right to sell those shares back to us. So what does all that mean essentially in plain English? When we sell a 9-strike put on RMO, what that means is someone has the right to sell us shares of RMO at $9. But as we can see here, even if it finishes at $8.37, that's okay because we'll still hit a $1,000 profit on that thanks to the option premium that we collect. And the way that this works is RMO, let's just look at line 10 right here, which is 6 as labeled on the table, just to illustrate this point of cash secured puts. Since we sold a 9-strike put, as we just mentioned, that means someone could sell us these shares at $9 a piece. But here's the catch, and this is where we get our big advantage as option sellers. We sold the contract for $1.15. So what that really means is that, yeah, they could sell it to us for $9 a piece, but unless the stock is more than $1.15 below that 9 level, we're going to make money, which means that as long as it stays above $7.85, and we could put this in here to illustrate the point, we're going to break even on this, and that would be a pretty big drop between 9 and 7.85 over the next month. And the best part is, hey, let's say it stays at 9, that put's going to be worthless, and we could throw the 0 in here to illustrate it, and we would make $2,300. And that is the advantage we get as option sellers, the fact that, hey, we could sell someone the right to sell us shares. So essentially what we're doing, the reason options exist are for, large institutions to hedge their positions. The reason options exist are essentially for people to buy insurance on their stocks. And what we're doing as option sellers is selling insurance, and selling insurance is wildly profitable, or else, if it wasn't, the insurance industry wouldn't be as big as it is today. So that's the idea behind what we're doing. And the second strategy that we could use are covered calls, which is what we did here. And for those, you need the shares first. They're covered right here, covered calls, in the sense that you own shares and sell calls that are covered by those shares. So again, backtracking conceptually to what a call is, the call is an option to buy as opposed to a put is an option to sell. A call is the option to buy shares at a predetermined price, the strike price, which is 12.5 in this example. So what we did here off the bat is, hey, we bought these shares at 11.34 and we sold a 12.5 strike call, which is giving the buyer of this option the right to say, hey, I want to buy these shares away from you at 12.50. But since we bought these at 11.34, hell yeah, we'd be thrilled to sell these at 12.50 because that would be about $1.16 gain per share on these shares that we bought. And not only would we get that gain locked in, we also get this 66 cents of profit here. So it just is a way to increase your gain on the upside where, look, you can get these called away. You'll know for a fact if they get called away, you make profit, and you get to collect the premium of the call that you sold. But the great part about these is this cushion that we like to talk about tonight. The downside, if the share price drops, we still get this 66 cents no matter what. That's why we're able to bag that $660. But that's what we talk about in when we're talking about all these option strategies that we have. They mainly revolve around cash secured puts and covered calls. And we put those together in a strategy that we call the HT wheel. And we've got a full video series about those on our YouTube channel that explain it way better than I possibly could with my little Google Sheet stream that I've got going right now. But if you guys are interested in that strategy and want to learn a little bit more about it, the YouTube channel is a great place to go to learn about that. And it's just called HT Wheel. I think it's a 4-part video series. But yeah, that's the end of our little discussion about RMO. We think we're in a good spot with that one with an 836 break-even price. And if it goes back above whatever, what was it up? Let me drag this. Need to redo the formula in here. Max 9 minus up here, comma 0. Perfect. So we're in a position right now where as long as it finishes above 836, we'll make money on the trade. We started that trade at 1134. So, objectively, that's a pretty solid place to be. And again, we're going to go back to our overall tracking tab and just go further down the list. RMO, AMD is a good one, a super solid one. And this is the start of what we like to call a 10-day play for earnings. And we think this is the perfect candidate for this, which is why we rolled our puts down from, we were selling 86 strike puts right here last week, and we're now selling 82 strike puts. So that's what we're going to be on this week. And I'm going to tell you exactly why we're doing that. Let me pull up the AMD chain. So here's the chart over the last 20 days. As we can see, a lot of movement. But if we back it up even further, we've got some decent upside potentially in the future because it topped out almost $100 a share back at the beginning of this year. So definitely a little bit of room to run. The last 180 days, the lowest that it's been is this, low 70 level. And that's something that's important to keep in mind here. The fact that it hasn't really been below 74, 73 over the last 180 days. And we're going to tell you why that's important. Because one of the strategies we like to run using these cash secured puts is what we like to call the 10-day play for earnings. So AMD reports earnings, as we can see over here if we click on this blue indicator, on April 27th, 2021. So looking at the calendar, April 27th is not this week, but next week. So the first part of this strategy that we're going to run on AMD is we are going to sell puts that expire this week. And we're going to sell those dead at the money. We're going to sell them at 82 strike. So as we can see, the stock price is 82.15. In plain English, what does that mean for us? It means that as long as AMD trades flat or goes up this week, i.e. as long as AMD finishes above 82, we'll hit max profit on this trade. So now the question is, earnings are the 27th. Why are we doing this for something that expires on the 23rd? And the answer to that is the fact that historically, and this has been proven through peer-reviewed research papers, and this is something that we like to look at a lot, leading up to earnings. So we know earnings are the 27th. This expires the 23rd. So this is the week, quote unquote, leading up to earnings. Greater than 50% of the time, a stock will be green in this week. So that means there's a greater than 50% chance that these are going to finish with max profit. So that's a way that we could use an upcoming event to put odds further on our side. The odds are already on our side when we sell options because if this thing trades flat, if it goes up, we're going to make max profit. And that's essentially, roughly 2 out of 3 potential scenarios. Things could either go down decently, trade relatively flat, in which case we make profit, or go up a bunch, in which case we'll also make profit. So 2 out of those 3 potential outcomes, we're making good profit, and we're further putting the odds on our side with that information where we know that the week leading up to earnings, stocks typically are green. So that's step one. And we could talk about this from a break-even price or basis perspective because that's the best way to illustrate the value of this 10-day strategy that we're going to be running on AMD. So the first part is 82 strike put. I've said that a million times. Hopefully you guys are on board with the first part of that as it exists, selling the 82 strike put. So again, there are 2 outcomes. Either AMD finishes above 82 this week, in which case, awesome, we're going to bag our profit and we're going to move on to a different stock. But as we so often like to focus on this channel is, what happens if the stock goes down, and that's something we always need to be wary of. So our break-even price on this initial 82 strike put As we know, our break-even price, let me pull up the calculator so I could do these calculations in front of you guys so you could follow along, and hopefully it'll make sense as I just ramble on about the wild world of option selling. So we sold an 82 strike put right here, and the premium as it exists at the end of the day, we'll use Friday end of day prices for this example, is about $1.50. We'll call it $1.50 as we can see right there. So our break-even price is going to be 82 the strike minus $1.50 of premium. So what that means for us is that as long as AMD finishes above $80.50, we'll make money. But if it doesn't, what's going to happen with the put? When we sell a cash secured put and it goes in the money, and in the money meaning it goes lower than 82, we're going to have those shares assigned to us because the person who bought the contract is going to want to sell us the shares at $82, since that's a higher price than what it is currently trading at hypothetically in the market if it finished at 80.5. But, point being here, talking about the basis and break-even price, we sold 82 strike for $1.50, so even when we are assigned these shares, our adjusted basis is going to be $80.50. So let's keep that in mind moving forward as we look at selling covered calls now. So like we just talked about, you sell cash secured puts. What happens if you get assigned on the cash secured puts? You take assignment of the shares. You now have shares in the 80.5 basis, and you're now going to use those shares to sell the covered calls that we just talked about for the following week, which is April 30th. And shout out to Matthew M in the YouTube chat. Appreciate the comments that you had on some of the videos. Always love getting comments on the videos. Always love people popping into the live streams. Always happy when new people stumble upon what we're doing in here. Any questions you have about literally anything at all, feel free to throw them in the chat and we could talk about those a little bit. But getting into this second week here, we know April 23rd, we sold 82 strike puts. We got assigned those with an 80.5 basis. Now we move into a situation where we have shares and we want to sell covered calls. But what do we want to do? What price do we want to sell those at? Oops, there goes my whole screen. We want to sell those above 80.5 because we know that's our basis. And if we sell them above our basis and our shares get called away, we'll make money. But the great part about earnings week is that it inflates the premium of these calls. As you can see for this week, you're really only getting, a little over $1 if you go slightly out of the money. Whereas for earnings week right here, if we look at the option chain, you can get a couple of bucks going all the way up to 85. And from a break-even perspective, you could get as conservative or as aggressive as you would like to when you're selling these calls. You could say, hey, I've got an 80.5 strike. I just want to get out of this for a profit. I'm going to sell, 82 strike calls right here for $3.30 of premium. So again, what would that mean if you sold those for $3.30 of premium? It means that your break-even price is now $3.30 lower. So you now have a stock with a break-even price of 77.2 when end of day Friday was trading at 82.15. And that's basically a 5 or 6% discount on the stock right off the bat. So this is a great way to enter. Looking at it in the context of where 77 is on the chart, you'd put yourself right around here. And that is a great place to be if we look over the last 180 days for AMD. But there's another little wrinkle to this where we can make it even further, or we could push our basis even further down. So we know that it's 77.2, and we've sold these calls that are going to expire April 30th. As we said earlier, AMD's earnings are on April 27th, which we'll pull back up the calendar for reference. That's right here. So the idea is this is the day you would sell those calls. Your basis is now 77.2. The next day is earnings. So what's going to happen after earnings with the premium on these options? So one of two things are going to happen. Earnings are typically a pretty binary event. Either they're going to blow out earnings, the stock's going to go up, and you're going to have your shares called away. So you're going to have shares that you have with the 77.2 basis. You'll get those called away for 82.50. That's roughly a 5 or 6% return in just over a week or so. And that's a great situation to be in. Anytime we can get that kind of return in such a short period of time, 1 or 2 weeks, we take that 10 times out of 10. And again, like we mentioned with probabilities surrounding earnings, you making profit on one of these first two steps of this trade is statistically probable. And that's what we love to do around here. We love to put ourselves in high probability trades where we're going to make consistent profits week after week and stack them up to get nice annual numbers, as opposed to just chasing huge unlikely overnight returns and essentially playing what's a glorified lottery at some points that you see some options traders doing. But, to further the point, you've sold these, you have a 77.2 basis. We said if it goes up, you're going to make some money. But what happens if it goes down after earnings? What happens if it goes down is that these 82 strike calls that you sold, they're going to be almost worthless. So what you could do is know that, hey, I've got a 77.2 basis. The 82s that I sold are worthless. You can move even further down for the same week by closing the 82 strike calls and then selling something like a 77 strike call for maybe $1 or $2, which if we said you got $2 of premium or something on it, we would drop that even further. And again, this is all for that same week. This is a trade where you would close the initial calls and then sell more calls. So by April 30th, you would have a basis of 75.2 in your quote unquote worst case scenario where AMD keeps dropping. But, bringing this full circle and looking back at the AMD chart as we just did, if you have a basis of 75.2 on AMD, that puts you right here. And in the context of the last 180 days, I just pointed with my finger and realized you guys couldn't see that, but you're below this point right here, which looks like a point of support. You're right around this point of support. You're right around this point and this point. And then, as we know, the shares that we own never expire. The only thing that expires are the options that we sell. So we could just keep selling calls week after week and driving this basis down dollar by dollar by dollar. And essentially, even if AMD keeps dropping, you could find yourself in a position where by summertime, you've got this thing with the basis in the low 60s, which we've got to zoom out on the y-axis here because that is such a low price to be at. You'd be down in this area, and that is something I would be phenomenally comfortable with, and that is why I think AMD is such a great trade for those 82 strike puts as we head into this week for an earnings type play on this. So let's flip back over. That kind of closes the loop on that little point I was making with AMD. That's why I think that one is a great one to be in for this week, and that's why we're in on the 82 strike puts. Clover Healthcare, this is another one where the conversation of extrinsic value on options that we sell is enormous because we're selling these 7.5 strike. I'm pulling the calculator back up. Bear with me to do a little math here. Actually, you know what? We've got Google Sheets up. This does all the math for us. I think the calculator might be a little bit redundant. Hopefully these numbers aren't too small for you. But what we've done here, we've got a 7.5 strike put, and we've got 72 cents of premium on that, which means that our break-even price essentially on that trade is going to be 7.5 minus that premium of 0.72, giving us a 6.78 break-even price on CLOV just over the next month. And if we evaluate this from return on risk perspective, since this is our break-even price, this is quote-unquote our capital at risk. So if our max profit is 72 cents, which is going to equal this cell right here, divided by the amount we have at risk, 678, that is a 10.61% return on a month-to-month basis. That's 1 month, 10% return on something that is relatively high probability. And let me show you how high of a probability that is. We know if we sell 7.5 strike puts on Clover Health, it just needs to finish above 7.5 for us to make a profit, correct? And the answer is yes, that is correct. So let me pull up the chart again and show you where 7.5 is. So as long as it finishes above here, you're going to make max profit. You're going to make 10% in a month, which is a huge, huge, huge number. And even if this thing steadies out a little bit in this $9 level that it's at, and that's another thing that I want to point out, it's at $9 right now. You've got a $1.50 cushion, and you might be saying, okay, I might have a $1.50 cushion, but it also just jumped up from $7.50 literally just a few days ago. You'd be 100% correct about that. Great observation. But the point is there was a little bit of support in this, $7.50-ish range. And like we just mentioned, your break-even price on this would be $6.80, which would put you right around here. And as we can see, with the exception of one little red wick on a candle, this thing hasn't traded below $7 in this 680 range in a long, long time. So that is why we love the opportunity that this presents us with, and why we think these CLOV 7.5 strike puts are a great option heading forward if you're looking for a play over the month or the back half of April, first half of May. So that's why we loaded up on those and kept rolling our position forward. Objectively, we're pretty happy with those. And I do want to loop back for a second to what we talked about at the beginning of our stream, which is the fact that, hey, a lot of these things that we're doing essentially are glorified ways of chasing premiums. And if we go look over at our HT Wheel Performance Tracker, where we could actually look at the performance of the stocks that we've picked, the stocks aren't good. I mean, there's no easy way to say that, or no easy way to sugarcoat that. Just over the last 20 or so, over the last 21 trades, the average return on our stocks has been negative 12%. So straight up, we need to get better at picking stocks. And that's why I'm trying to cycle more into a portfolio that's full of stocks that are in the S&P 500. So when the overall market has been moving upwards, we'll, be the beneficiaries of that. And we know in the long term, the market is always going to go up. We're going to have pullbacks. We'll have corrections. But, 20 years from now, the market is going to be higher than it is today. That's just how inherently it works. And on a year-to-year, long-term outlook in the capital markets, that's how they work. And that's why our strategy is based on an underlying bullish thesis where all of these are playing stocks upwards, while at the same time giving us a little bit of cushion on the downside. So what's my point when I bring up all this is that I'm trying to evaluate my plays and be objective and help people understand who follow along what I think are good, safe plays and what I think are a little riskier in chasing premiums. So I've indicated that with, green being a safer play. AMD is a nice safe play because you're going to have a blue chip stock potentially at a really nice basis if that one plays out the way that we talked about. The other one that we've got here is UWMC. We think that one's super solid, and we've got a low basis on that. We're perfectly happy to keep chipping away at the premium week after week after week. And then the other one that we've got here is ICLN, and that's a clean energy ETF. To be completely honest, the premium on it isn't as great as it was when we first started playing it. I do love the clean energy area and industry, and I'm looking to invest in more plays in that sector. However, the premium dried up a little bit. I'm honestly just trying to get out of this one, and I'll keep selling these things for 15 cents a week until I finally do, and that's the idea behind that. But this is labeled green because it's an ETF. It's based off clean energy. There's not some huge thing that's going to swing this stock one way or another. So this is one that we could keep relatively low stress, be patient on, and eventually it'll come home to roost and be called away from us one day at some point in the future. And then orange here, we've got our hedges, which are SPX, and we are very, very heavy into hedges right now. I could candidly tell you that as we head forward into the next week. If tomorrow is red in the market, we are going to make a decent amount on these two right here. We're going to make about $3,000 on that if the market is just, not insanely green tomorrow. So we're looking forward to that. We also have this larger position here, whereas long as we don't break this 4,200 barrier, we'll get another $4,400. So we're in a position where we're very heavily hedged against the market. And to be completely blunt, it's unbalanced and based entirely on our thesis that, SPX is wildly overbought. We could bring the chart back up for those of you who have tuned in a little bit later for this stream that we've got going right here. But SPX, pulling it up here on the 1 chart, and RSI is our favorite little indicator that we like to use. Anything over 80 indicates something is overbought. The last time RSI on the S&P 500 was this high was back in September, and that is when it dropped 10% basically in the following week. So we're loading up on that. We've gave ourselves one thing we mentioned that we messed up last week was we didn't give ourselves a lot of time with these 416s. What we did this time was give ourselves until 423 on that, so we'll have the entirety of this next week to wait for a pullback. And if we don't get a pullback, we could either roll these forward to the following week or evaluate what we want to do from that point moving forward. But that's where we're at with those. I mean, they are objectively risky. This is about as risky as I'll get with this because they could result in a decent loss, but I am trying to essentially hope all of these expire worthless and I can make back the losses that we had on our spreads from last week and get our account right back to where we were and, business as usual. Things can't keep going up forever, but again, the famous saying is that the stock market can remain irrational longer than you can remain solvent. So this is kind of the end of what we're going to be doing as we fully tilt into those call spreads. But yeah, that rounds out what we've got and what we're holding on to this week, our ideas behind all the things we're holding. Overall, I've got a little bit of cash on the sidelines right now, as we just mentioned with XPX. I think we're due at least for a decent pullback, so I'm waiting for that before I start deploying that cash. These are tying up a decent bit of cash. We might get out of this AMD position at some point soon, but everything else I'm relatively okay with holding on with. Okay with holding on to. It's already getting to the point of the night where I start stumbling over my words, so we might have to wrap this up soon. We're hitting the hour mark. But again, these are all things I'm comfortable holding for the next month. They're all relatively conservative strikes. I sold 7.5 on CLOV, which is currently trading $1.50 above. LOTZ, the 7.5 strike is right around where it's currently trading. The UWMC 9 and 9 right here is a relatively conservative strike compared to what we had been doing. But that's kind of the game you play here. Do you want to sell a higher strike put and try to get more profit, or do you want to sell a lower strike put and be safer in the event that there's a pullback? So in times like these, when we have the setup that we're talking about right here and the market looks the way it does and we're anticipating that kind of a pullback, the things we could do on top of hedging against that are just being more conservative with the strikes that we sell. And again, that's the game that we play, that trade-off between risk and reward, where there really isn't a correct answer. It's more so for your personal risk tolerance and what kind of returns you're trying to make on a week-to-week basis. But as long as you're on the option selling side of things, you're probably going to be just fine. But yeah, that wraps up what we've got going for this week. And since we are anticipating there's a little bit of a pullback, I don't want to, encourage throwing too much money at the market right when things open. So I'm not going to go too far beyond the current plays. I like what we've got. If you wanted to join us on any of those, I think these are all good options to be in at this point. And I think we've done a good job objectively evaluating the positions we're in, saying, hey, we're not just holding on to this because it's a loser and one day we can make it a winner. We're holding on to this because, hey, if I had 10 grand in my pocket, I'd be okay with making the same exact trade today. The sunk cost fallacy could be something we grapple with a little bit. We did take our first loss on VGAC here. We took a little bit of a loss there because the stock dropped a bunch. The premium disappeared on us. And, it's one of those things where that collateral, that 15 grand that we had tied up in that trade, is going to be better spent on other trades. And that's just the way it works sometimes. You can't win every trade, but if you look at our win rate of 91.11% as it stands right now, it's still pretty damn good. And we've still got a really nice amount of total profits overall since we started detail tracking this HT wheel strategy from the end of last November. So yeah, that's what we've got set up for this week. If you guys are just joining us on the stream, feel free to join our Discord. We're try to be a little more active there on a week-to-week basis and throughout the trading day to talk about trade ideas, strategies, anything that's coming up during the week. And that's all we've got. So if you've got any questions, feel free to come join us in the Discord, throw those questions into the Discord. And we will be back with another midweek stream. We try to do those Tuesday or Wednesday nights. I'll probably put a poll up in our Discord to try to see when we have the most people available. It's definitely more fun. The more the merrier in here, where we can really get the chat going and get some more ideas coming in and get some more stocks to look at. I think there's always a good time. But for those of you that are on live with us right now, I appreciate you spending an hour of your Sunday night with us. We will check back in sometime midweek, and hopefully the account balance we got in the top left will be a little bit higher when we talk next. So thank you guys for joining us tonight. We'll sign off the way we do on all of our videos. This has been the Hourglass Trader, where as time passes, we make money. Thank you.